Is there any place to keep your money from keeping you awake at night? Rob Morgan is the Chief Investment Officer at Sethi Investments, and he joins us now. Rob, I mean, listen, we know, we get all the stories, right? August, a lot of people are gone. There's not a lot of volume, so the swings can be bigger. But this month feels a little bit different, maybe a little bit more serious than just the dog days of August, if you will. Where are you advising clients to put their money, if anywhere, besides under the mattress, that can avoid or protect against some of this volatility?
Yeah, Brian. Well, you kind of opened the show talking about the inversion of the yield curve, and it's gotten worse. And of course, the longer it stays that way, that's a troubling sign. But I guess one thing that we don't really know this go around is what's been the impact of all this global quantitative easing. So I'm not yet ready to throw in the towel on stocks. I would still overweight, broadly speaking, and one reason for that, I guess maybe I'm whistling by the graveyard, but a number of analysts are projecting that earnings growth will reaccelerate next year. Now it's been pretty lousy this year, but so I would certainly stick with an overweight on stocks here, and we can kind of delve into the various sectors that I'd like here as well.
On market as it pertains to stocks, and I see all the headlines. I get it. I'm a CNBC viewer as well as obviously a CNBC host. In the bond market, you can look at it two ways and say, okay, wow, that inversion is predicting a recession, everything's doomed. Or you could look at it like bonds have just gotten out of their saddle, if you will, and that extremely low yield makes A, stocks more attractive, and B, makes it possible for companies to refinance their debt, generate some cash from the bond market, buy back more of their stocks, and maybe make a more optimistic case for the equity market.
Well, absolutely, and that, I would add that on to what I mentioned before about the impacts of quantitative easing. It's not a done deal that a recession is going to happen in 18 to 24 months, like an inverted yield curve often projects, and it's not 100% accurate. So I think you're certainly making a strong case that equities could continue to do well in the foreseeable future.
Okay, let's get into some of the areas of the market that you like. Is big cap, the biggest caps, the dividend payers, the safest place to be?
Yes, and here's why. With the Fed pivot that's happened over the last 6 months, and obviously the Fed taking a rates down approach, at least for the foreseeable future, that's probably going to nudge the dollar down going forward. Not in a big way, but we'll see a downward bias there. And a dollar that's going down tends to put a boost into the big cap multinationals. It really helps with their sales translations coming from overseas. So I'd overweight the large cap space versus small cap, particularly in growth stocks, and also for U.S. investors investing overseas. This is probably a time to overweight international investing as well. Why
do you think financials are a good deal, especially given those low yields?
Well, and you pointed out that the financial sector has been one of the real losers here in August. And I think partly, and of course, along with financials, I like consumer staples and technology. I think a big reason, I think the selling's been overdone in financials. I think, there is some visible earnings growth. Valuations are attractive because of all the overselling going on. So yes, I would definitely overweight financials here.
In your bet, recession in the next 12 months, Rob?
Right now, I'd say 20% chance. The longer the inversion stays in place and the deeper it gets, that would go up in my mind. But I'd say 20% chance right now.